Well, the good news for today is mortgage rates didn't spike from what happened yesterday with the Federal Reserve. So let's recap what happened yesterday. So those that are new to my channel, my name is Dan Free. I do the rate update every day because I want to make sure you're an informed buyer. If you decide to buy a house, we would really love to be your mortgage person because we can walk you through all parts of this complicated scenario because it usually it creates anxiety when you're looking to buy a house. You're like, I don't really know what to do. I've never done this before. That's what we're here for. So on my channel every day, what I try to do is give you the economics on a daily basis, just what's going on in real estate with mortgage rates and so forth. And then we have a live event once a week. Me and Kyle Seagraves of Win the House You Love. If you haven't checked out his videos, please check those out. He's a member of my team. So what we try to do on a weekly basis is answer all first-time homebuyer questions that you guys have, because there's tons of people out there that are just like, I would really love to stop renting, but I don't know what to do. So if you're at that point in your life, we would love to consult you. So on a daily basis, what I do is I provide you guys information that give you kind of a feel what's going on in real estate, especially the financing piece of the puzzle. So where you're seeing on your screen right now are where mortgage rates are today. But hold off just a second. Yesterday we had the Federal Reserve come out with some information, and I really want to get to that point of it. So I'm going to give you some economic news, then I'm going to give you my analogy of what the Federal Reserve said and did yesterday, and then we'll get on to mortgage rates. So really we see some things that are really starting to scare me now in regards to the economy in general. It's starting, yes, I'll say it took a little time, but now what the Federal Reserve is doing is starting to kind of thump everybody on the head. So let me explain to you. We're starting to see some things in retail sales, consumer debt loading up, and consumer discretionary income coming way back down. And why I'm focusing in on this is because the Federal Reserve is saying, you know, we really have to put a damper on the employment numbers. Well, they've already done that to housing, and even Federal Chairman Powell said, we're not going to feel the full impact on this in housing for probably another 6 months. So I'll address that here in a minute. But we're starting to see retail sales starting to plummet because people are starting to not have as much money in their pockets. Let me explain what I mean by that. So we look at the money supply, and I'm a kind of an economics geek, so bear with me, but there's context here that I want you guys to get. So what I want to show you here is this is what's the money supply is. This is how much money is in circulation. So you can see through over time, you know, we had the money supply increasing and increasing and increasing, and then all of a sudden, wham, whammo. The Fed started printing money by the bazillions, and the government started handing it out. So we had that spike. Look at the spike, but now we've peaked. So back in March, between March and June, a lot of things are peaking, and you're going to notice that on some of these charts. And this started to go down. So again, this is what's going on in this market right now with the money supply. How much money's out there? So it's starting to come back down. The Federal Reserve is clamping down on things, and they're selling and doing whatever they can to suck money out of the system. The other piece is, here's real disposable income that we talk about all the time. Look at this. So this is real disposable income. How much people have in their pockets after they pay all their bills. So you can see over time, just like the money supply, it increased. And then all of a sudden, look right here. In 2020, 2021, people had the most disposable income ever in history. How can that be? The world shut down. Nobody went to work, and the government basically sent stimulus money to everybody. Well, that's why. A lot of people didn't lose their jobs. They were furloughed and maybe got paid a little bit. Now, you might say, Dan, I lost my job. Well, okay, I get it. But the majority of people, we can show it right here on the screen, had more money than they've ever had in history. What do we do with that money when we're Americans? Well, we spend it. Well, that's starting to kind of play a toll on us as well. So let's go back to the money supply. And there's purposes for this. You saw that we had way extra money in our bank accounts back here. And now what's happening? That's being depleted substantially. But then let's go over to this chart. Here's household debt. Look at household debt. Where we were, everybody says they were freaking out back in 2008 time period and so forth. So let's look at what consumer debt was at that point. Non-housing, let's just look at non-housing debt, because it's hard to look at the housing debt because the numbers are so high because of house prices. But let's just look at consumer debt, non-housing debt, 2.6 trillion. Okay, that's where we were back in 2008. And then it went down, the economy got a little stronger and so forth, and then we started spiking. And then we hit the pandemic and everybody started to charge. But they had enough money in their account to basically pay it off. But let's look at where we are now. Non-housing debt is now $4.5 trillion. And we were at the pandemic, or at the crash of the world, at 2.6. Okay, so we have a lot of debt in the system right now. Why is this scaring me? Well, the reason why it's scaring me is the Federal Reserve is saying we're going to put a pain on those or the jobs market. Okay, so let's look at it this way. You had a bunch of money during the pandemic. A lot of us did. And then we continued to spend because we were excited to get out of the house. It's like I can travel. Now I can go out to dinner. Now I can go out and party with my friends. I can do all this other stuff. And we're used to charging it. But then at the end of the month, we have enough money in our account, as the disposable income chart said, is we could pay off that debt. But now the debt loads are increasing. And not only that, the Federal Reserve is raising rates, and they've raised rates over 4%, an additional 4% this year. So look at it. If your interest rates on your credit cards went up an additional 4%, you'd feel the pain. Look at it on the corporate level. If you have billions of dollars in debt that's rolling over, and now you have to refinance that debt at a rate that's probably twice as high as that you have, well, now your debt load or your servicing load just increased. So that's the big thing we're starting to worry about right now. But the Federal Reserve is saying, guys, we're going to keep raising rates until you guys stop spending. And that's the only thing that's really going to drive down prices. So in a roundabout way, they're trying to help us, the consumer, stop spending so much. So let's get over to the Federal Reserve now. I'm going to give you some context, one big piece of this puzzle that I took out of this, but then I'm going to give you my thoughts on it. The Federal Reserve just came out and said, we plan on having the rate that kind of we control, and it's the federal funds rate. We want it, in the last meeting, they said we want that rate to get to 4.6. Then yesterday, they spun that data and they said, now we want it at 5.1. Okay, so that means rates have to increase another 0.5%, okay, from where we are today. So does it really have to? Well, the markets aren't telling us that it has to, because some of the markets, the bonds that we follow, are running around a 4.1 yield right now. And that's kind of giving us the, what is really going on? So let me just put this into context for you. Just a little over a year ago, right now, the Federal Reserve came out and said, we have no plans on increasing rates until at least 2023. Well, then forward fast about 3 months from there or 4 months from there, and then they started on this rapid rate increase. So now they're telling us, well, we're going to keep rates as high as we can for as long as we can, and there's even possible rate increases in the cards. Well, a lot of the bond markets and everything else aren't telling us that. So right now, I'm still sticking with my analogies. I think rates are going to be at 5.5. They're going to stick right between 5.5 and 6. They're going to teeter up and down a little bit when we get into the normal periods of 2023. Right now, rates are about 6.25. You're going to notice today, even after the Fed raised rates today, what happened? Well, let's get over to that. You're going to see where mortgage rates actually went down a little bit. Okay, so let's look at this context. What you're seeing on your screen is the average rates out there today. These are not my rates. These are not in the individual banks' rates. These are the national averages. And again, I want you guys to focus. The 30-year fixed rate now is at 6.27. Just 2-3 months ago, we were at 7.375. So we're 1.1% off of the highs. So if you refinance or bought a home during those times and you have those rates, you can refinance at any time. Reach out to us and let's see, based on your numbers, can you save some money? Okay, so that's what's going on with rates. So even though the Federal Reserve raised rates yesterday 0.5%, down from the 75 basis points that they were doing, rates actually eased a little bit. And since they've made 2 or 3 more adjustments up, rates are down over 1%. So could this help the real estate market? Time will tell. So I do this report every day to help inform you guys what's going on with real estate. Hopefully you'll find value in my channel. It's entertaining and educational. And if it is to you, please, all I ask you to do is give me a thumbs up, subscribe down below, and hit the bell every time I post a video. You get an alert. God bless, guys. Thanks so much for joining me last night on our live event at 5 o'clock Central Standard Time, and even my noon one. We had probably on average about 100 or 200 people on there at all times asking questions. So thank you to all you guys that were visiting me there. But if you'd like to find out more about me and my team, what we do, we can help you with a mortgage anywhere in the country. Just check us out at therateupdate.com, or if you listen to podcasts, we are probably probably on your podcast that you listen to. So just go in the search button, plug in my name, Dan Frio, or The Mortgage Update. It's called The Mortgage Update on podcast, The Mortgage Update with Dan Frio. And you're going to find these videos and all my radio shows on there as well. So thanks for watching. Thanks for listening. God bless, and I'll see you tomorrow. Bye-bye.